Hey everyone, today what we want to talk about is market participants. Now, this isn't material that's necessarily examined in the exams, but there's so much we talk about which is about the psychology and understanding what large funds are doing to RIAs and fundamentals, and how as technicians that we can get advantages out of these things. And so it really helps to understand the structure of the market. Now, this is really the result of probably 5 years of analysis that I've done as we were trying to understand who are the users of our software and where do they fit in the market and what are the typical things that they're doing. So it's only a quick session, but it really helps put in context a lot of the information that we're talking about in the rest of the course. So when you look at the market, there's a buy side and there's a sell side. Now the buy side firms are the huge investment companies, the Fidelities, the Morningstars, the Vanguard, etc. They are basically the funds where they are buying the equities, the commodities, the fixed income, and they're pooling all this client money together to buy investments. So that's the buy-side firm. It's not that they don't ever sell. Of course, they buy and sell, they add to their portfolio and they remove from their portfolio, but they're a buy-side firm. Now, a sell-side firm is essentially the broker. So when a buy-side wants to trade and add something to their portfolio, they will go and talk to all of their sell-side contacts to basically buy the securities or sell the securities to them. The thing about buy-side firms, which is why they're so important to us, is that their driver isn't always capital gain. That's nice to have. A portfolio that's appreciating in capital value, but it's the dividends, it's the yield, it's the returns from the fixed income which are so important to them. And so, these are the sorts of things that they're looking for. It's what we have to understand. As technical analysts, we have to know what's driving these things, because that's what causes the trends and makes the trends persist over time as well. Their typical hold time is years, or at least months. They're not just saying, let me buy Microsoft, and then tomorrow, oh no, I changed my mind, my stop's been hit, I'm going to sell. It's not the way they work. And so it's very interesting. I always find it amusing. I get some people who come to me and say, hey, got this great tool, please make sure that no one on Wall Street ever sees this, because if those firms got it, I'd be gone. I'm just shaking my head saying it's not how they work. They really don't care. Even if you had a tool that returned 50-60% a month, they are not putting their money in there because they just can't move in and out that quickly. Sell-side traders, basically when you've got a sell-side trader who is filling an order for the buy side, what they're going to do is look at their own book first and say, do we have someone else on our books who's trying to sell that equity that the buy side wants to buy? And if so, we're going to match the order in our own universe or the dark pool before we send the order off to the open market. And so that's where dark pools come from as well. They're not as evil as they sound. It's just sell-side companies matching orders on their own books. Basically, typically and this is a really important point, typically a buy-side firm is paid for assets under management. Now, there are some changes that may be happening to that, which is going to make it really interesting what goes on in the future. So we're just going to have to watch this anyway. Sell side, they make their money on brokerage fees and also trade timing. So let's just go through, in the buy side, we've got the portfolio manager. Essentially, this is the guy at the center of the universe. He is adding stocks in. He's being judged based on relative performance to the index. So for instance, if you're running a US large cap fund, well, the S&P 500 is your benchmark. And if you consistently are underperforming the benchmark, well then clients are just going to say, I could go to an index fund and get a better return. So, why am I going to stay here with you? So the portfolio manager is under a lot of pressure to outperform the index. because that's how they keep clients. That's how they keep either assets under management, fees based on that, or fees based on performance. The performance against the benchmark is critical to them. Typically, when a portfolio is created, it's created under a mantle, or it has a mandate, I should say. It's either going to be high growth, or it's going to be large cap, or something like that. The most appropriate index is what's used for that. And the PM's gold. Now, one of the most common tools we use in institutional or get asked for is the relative index comparison, which is that tool there. Basically taking the value of Apple in this case, dividing it by the S&P 500, and then working out the gains and losses on a percentage basis. And it's, this is what opened up my eyes to all of this, is seeing how often we were asked for these type of indicators. All right, so then we have the buy-side analyst. Now the analyst is usually be it a technical analyst or a fundamental analyst. They are responsible for feeding ratings and information to portfolio managers. And so this is where there's a lot of technical analysis jobs available as well, because even though portfolio managers may be making decisions on fundamental basis, they do want to know what the technical is. They may have made a decision to buy something and add it to their portfolio, but they want to get timing from a technical perspective. And again, in this chart here, we've got, it's typical where an analyst is going to say, well, this stock is a hold, or it's a buy, or it's a sell, or it's a strong buy, or it's an exit. Those sorts of things as well. And so typically they'll write their reasons for it and send that report or send that chart off to the portfolio manager for them to look at. There's a huge focus on relative strength analysis, is what I've seen with analysts that are supporting portfolio managers. Quite often these bigger firms, they're mandated that they have to stay in the market at all times. They don't have the luxury of being able to say, let's just go to cash because the market doesn't look good. And so again, the analysts are just looking at it saying, all right, well, if I have to be in, let's go and find the stocks which are performing the least bad out of all the bad ones. Then we have the buy-side trader. PMs don't typically trade themselves, depending on the size. They're going to pass their orders on to the buy-side traders, who sit there then and execute. Now, depending on the relationship, there are some buy-side traders who will have a discretion about how quickly they execute. Quite often a portfolio manager is just going to say, I want to have 1,000 share, or 1 million shares of Microsoft added to the portfolio, not willing to spend more than this price. See what you can do. And then the trader's just going to work over the following days to scale into that position, works all their sell side contacts to see who's got trades. And really it's a little bit of brinkmanship going on here, where the buy side trader doesn't want to expose to the market that they are a huge buyer of this equity, because they don't want the price to go up. They want to keep it low and to get as much as they can at this low price. From a Dow theory, we're in the accumulation phase, where they are accumulating all of those shares as well. Good traders have discretion. When it's a junior trader, the portfolio manager is going to say, buy here, that's it. Whereas good traders will then have a little bit of discretion to sort of say, oh, I'm not going to put that order in straight away. I'm going to wait because I think the market's going to go down based on the analysis that I've been doing. And so, we have that. There are sell-side analysts. I think I'll talk about that in a moment. Two variants of the portfolio manager. So you've got at the huge level. What we've talked about is this scenario at the huge level. Now at the medium level, you've got RIAs. Typically there, we're getting into a place where the portfolio manager may also be the trader and the analyst. Or maybe there's an analyst and it's two people, but they're getting to a smaller scale. Still has the same sort of structure, still trying to outperform, still investing client money, and clients, are looking at the news every night to see where the S&P is, and they want to get performance over that. Then we get down to private traders, where it's always one person doing everything. And if that's you, if you're basically trading your own account, really important to think about the 3 roles. I'm doing analysis, which is completely without any bias to what I may have put in my portfolio. All I want to do is analyze these stocks. Do I think the trend's up? Do I think it's down? Do I see a change in trend? The issue that a private trader is going to have is that they come to their analysis with the bias of the decisions that they've already made in their portfolio. We talk a lot about bias and decisions and perceptions in CMT2, but these are things that you've got to be very aware of. So again, and typically I would say a private trader is only after capital gain. Very rarely are they after investment or dividend income, unless they've got a very huge, large portfolio, and their hold time is typically smaller. So on the sell side, we've got the sell side trader that the buy side trader talks to. These floors are the noisy ones. I've been on buy side floors and I've been on sell side floors. These are the crazy Wolf of Wall Street style trading floors where there's lots of noise and things going on. But they're matching orders. There's orders coming in and they're trying to find within their own pool, can we match that order out? And so, again, a educated senior trader may carry a trade. They may look at this and say, hey, I'm willing to give you this fill at this price, even though it may be a small loss on what the current market value is, because I see that as time goes on, the market's going to drop and I can pick up the other side of that order for less. So there's a lot of work, and we deal with clients, we deal with technical analysts in all of these roles that I'm talking about, and so there's a lot of roles there for people to work in. The sell side analyst, the last one here that we have, we've basically is an analyst who works for the sell side firm because the sell sides want to get the favour of the portfolio managers. They want the buy side firms to send the order flow to them. And one of the ways that they've done that historically is to have sell side analysts that are doing analysis, sending out reports, maybe even to smaller firms that don't have their own buy side analysts, but are relying on the sell side analysts to send them research. And there's a whole huge area that's available in the marketplace as well on this. But essentially, the sell side firm, again, because they know that portfolio managers are measured on a relative basis, they are giving a lot of analysis in terms of relative strength, trying to find what is the best relative outperformer. Now, again, as we go through the CMT program, we're going to be talking a lot about relative strength and relative strength techniques. This is why, because when you talk about the largest funds and the RIAs in this industry, relative strength is how they're judged. They have to outperform the benchmark. So each of their performance is judged against the benchmark, and so they're looking for stocks that have got relative outperformance compared to the benchmark. And so that's why this is so important, and so much of what we do comes back to this. Dodd-Frank reforms made some big changes. Sell-side analysts, there's like this wall put between sell-side traders and sell-side analysts. There was a lot of things going on where analysts would warn the traders beforehand of what research they were about to put out. So, they could take opposite positions and things like that. So it's really just, those changes made. Obviously, as we come further and further away from 2008, we may start to see elements of Dodd-Frank repealed, which would have an interesting effect on the market and possibly drive another boom again. So keep an eye out on that. As I said, this isn't material that's necessarily going to be examined. There's, some of it, it's really just to help you get really good context about the whole market structure, understanding these different roles that we talk about. You know, we often talk about large funds and portfolio managers and the fundamental decisions that they're making. You know, we're going to talk about traders, we're going to talk about analysts. As technical analysts, the ideal role for most people is to end up being a analyst doing research. You know, and again, it's the portfolio managers who are the ones that are consuming research. So again, just to help you understand the market and how all of this sits together, and I hope that's been beneficial. But we'll continue on with the rest of the material in the next session. Thank you.